Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. Well, SVB and then Credit Suisse have spooked the markets. Those who've been around for long have already started drawing parallels between these events and the ones that brought about the 2008 financial crisis. I'd like to believe that the comparisons are unfair. We've collectively learned something from the 2008 crisis that should hopefully prevent a repeat of 2008. But nothing can be said for certain. It is a far better option to be prepared than hope that the authorities may prevent a 2008 like crash. As the famous saying goes, predicting rains does not count, building arcs does. So don't try to predict the rains and start building your arcs if you haven't already, in the form of risk diversification and proper asset allocation. I'll perhaps cover this topic in greater depth later on, as today I'm going to discuss a different topic. I'm going to talk about a strategy that's fast becoming popular and that may have just become more attractive thanks to the SVB collapse. So here goes. Now many new investors get a shocker when they realize that investing is not what they made it out to be. They can't believe it when stocks of companies declaring bad quarterly results go up and the ones with good quarterly results go down. They are surprised when stocks from the so-called hot and growing sectors underperform the ones from cold or slow growing sectors. I think this confusion arises because they confuse the price of a stock with its value. You see, in the stock market, price is what you pay and value is what you get. A stock will not make money for you over the long term based on whether its quarterly results are good or bad, or whether it belongs to a hot or a cold industry. In the long term, you will only make money if you buy a stock well below its intrinsic value and give enough time for the price to converge to its value. This type of investing is usually known as value investing and its practitioners value investors. You see, nearly every stock has a certain intrinsic value based on the profits it can generate under normal conditions. Value investors compare the share price of the stock with this intrinsic value. If the share price is significantly lower than the intrinsic value, we get interested in the stock. And if it's higher, we avoid the stock and patiently wait for the price to go below its value. Now, value investors like me don't mind investing in a stock with poor quarterly results or belonging to a cold industry. If they believe the stock is undervalued and it's trading below its intrinsic value, they are game. In fact, they are of the view that stocks with good quarterly results or the ones from hot industries are sought by many investors, and this makes them expensive vis-a-vis their intrinsic values. Therefore, the value investing motto is to deliberately look at stocks where the quarterly earnings are going to be bad for a few quarters or which belong to sectors that are not particularly hot. Now, this value investing strategy may sound good in theory, but does it work in practice? Is there proof of a value investor using this approach to earn fabulous long-term returns? Well, yes, there is a lot of proof. None bigger than perhaps Warren Buffett's stellar track record. Buffett is an out-and-out value investor who's followed the value investing playbook to the T. Likewise, there are perhaps thousands of investors all around the globe who followed the value investing principles and earned market-beating returns over the long term. In fact, I did my own little value investing experiment and the results were encouraging. To me, a stock is a value stock if it has a P ratio of less than 15x, has a dividend yield of at least 2%, and has as little debt on the balance sheet as possible. You can assume a P ratio of 15x as an indicator of the intrinsic value of the company and a decent dividend yield as well as low leverage, an indicator of the underlying quality of the business. So if a top 500 stock by market cap is available at a PE of 15x or lower and is paying out dividends and has low debt, there is a strong chance you are looking at a decent quality value stock. Now I put together a group of 20 such stocks, held it for a year and then reinvested the proceeds into another 20 stocks that met these three conditions of PE, dividend yield and low debt to equity ratio. I did this for 10 years and then compiled the result. This simple value portfolio went up by over 5x between 2012 and 2022. This is a CAGR of 18% per annum. Is this good enough? Well, the Sensex is up 3x during the same period and has generated a CAGR of roughly 12% during the same time period. So any strategy that gives a minimum 5% per annum advantage over the Sensex is a strategy worth pursuing in my view. The value investing strategy I tested does give you that advantage and is therefore certainly worth giving a shot. The evidence in favor of value investing is thus irrefutable. If you practice it diligently and are patient enough, there are market-beating returns for the taking over the long term. Now what if I tell you I tested another strategy that was not value-based but gave even better results over the same period and over the same universe of 500 stocks? In fact, I had to repeat the process a few times just to make sure I was not making any errors. It turned out there were no errors. The gap between this strategy and the one based on value investing was indeed real. How big is this gap? Well, twice as better than the Sensex. Yes, that's right. This strategy applied on the same universe of 500 stocks and for the same period has multiplied investor money by 6x versus the 3x returns given by the Sensex and the 5x given by the value investing strategy. And the way it has accomplished this is by doing all the things that value investing forbids you to do, but in a more systematic manner. You see, value investing will ask you to stay away from hot sectors or companies that are likely to post good quarterly numbers. Value investing asks you to stay away from yesterday's winners and get close to yesterday's losers, because yesterday's losers often become tomorrow's winners and vice versa. This strategy, on the other hand, asks you to invest in yesterday's winners, but only of a certain kind. These certain kind of winners don't go on to become losers immediately. In fact, they continue to be winners for some more time. This gives investors a small window to make some quick bucks. And then, when the trend starts reversing, the investors can book their profits and move out. So here's what I did. I took the same universe of 500 stocks that I did for value investing, but this time the portfolio did not comprise of value stocks. It comprised of those 20 stocks that had gone up the most over the last 12 months. That is, the winners over the last 1 year. That's it. All you had to do to outperform the Sensex by 2x and also the value investing strategy by a considerable margin was to invest in the last 1 year's winners and then hold on to those stocks for another 1 year and then repeat the process again. At the end of the 10-year period, your corpus would have gone up by 6x by applying this extremely simple strategy. Now, before you regard this result as random, let me tell you that this strategy goes by the name of momentum investing. This strategy has emerged as one of the most popular ones recently. It has left investors and financial experts baffled by its effectiveness and its spectacular results. I have seen it work with my own eyes, and that too over a period of 10 years. Yes, it may not sound as appealing as value investing and does not have the concept of intrinsic value or margin of safety attached to it. However, it is based on the same behavioral tendency of investors that gives value investing its edge. In the case of value investing, people tend to overreact to bad news, and this results in the stock price going below the fair value of the stock. In momentum investing, however, people underreact to good news. Therefore, a stock does not go up all at once. It goes up steadily over a period of time. This allows momentum investors to jump aboard this rising tide and ride it as close to its top as possible. Therefore, if one follows a well defined process and buys and sells momentum stocks based on what has worked historically over a long period of time, one certainly has a strong chance of earning market beating returns over the long term. However, the $1,000,000 question in front of us is whether this is the right time to practice momentum investing. After all, with big banks like the SVB and Credit Suisse collapsing like a pack of cards and fears of a global contagion looming large, it is a high risk, high return strategy like momentum worth considering. Well, all I can say is that two of the worst years during my backtesting of both value as well as momentum strategies had been the years 2018 and 2019. And in these 2 years, the momentum strategy was down 23% point to point. In other words, it had suffered a decline of 23% between December 2017 and December 2019. And how much was the value investing strategy down by? Well, a strategy that's supposed to be safer than momentum investing, but it actually fared worse than momentum investing. Yes, that's correct. During the same 2-year period between December 2017 and December 2019, the value strategy was down almost 28%. Now, this is no reason to be optimistic about momentum investing based on just this data point. However, there is no reason to be pessimistic either in my view. A strategy that's as much rooted in human nature and the elements of fear and greed as value investing should certainly find a place in one's investment plans. In fact, with momentum underperforming its value counterpart in 2022, this may just be the year that this strategy turns the table on its more famous peer and allows you to start your momentum investing journey on a positive note. For all you know, the SVB crash and the small correction it has led to may have made momentum investing even more lucrative. And I'm sure you would want to know the list of 20 stocks that the momentum screener has approved for the year 2023. Here's the list for your reference. These are the stocks that are your top buys as per my momentum screener. The same momentum screener that gave 6x returns over 10 years. I can see a few Adani names there. Stocks that have suffered massive declines in 2023 already. However, since one is supposed to invest only 5% in each stock, the overall damage to your momentum portfolio is quite limited to that extent. Now, please note that these names are just for illustration purposes and are no recommendations from our side. So, caution needs to be exercised to that extent. Now, in case you want to know more about momentum investing and how I plan to use this strategy to try and earn market beating returns over the long term, I would like to invite you to an online event to be held on Monday, 20th March, sharp at 5 p.m. It is absolutely free of cost, and trust me, you will walk away with a lot of knowledge about momentum investing. I have provided the link to reserve your seat in the description box below. Do check it out. That brings me to the end of this video. I'll see you again next time. Goodbye and take care.
Hello from Team Equitymaster. We're glad you tuned into this video. If you liked what you saw and want more details on the investment ideas we covered, click the link in the description below.